we are going to work exercise 13.7 from chapter 13, which is a bond estimation of interest or yield, and we're going to create an amortization schedule based on the effective interest method. As always, let's look at the problem, we'll set it up, and then we'll solve for it. Okay, so 13.7 relies back to the facts from 13.6. So it says Devon Harris Company sells 10% bonds having a maturity value of $2 million for $1,855,816. The bonds are dated January 1st, 2025 and mature January 1st, 2030. It says interest is payable annually on January 1st. So it looks like what we have here is in 5 years, so we have a 5-year bond. We're, as Harris Company, are going to be required to repay $2 million worth of bonds. However, today we're only receiving $1,855,816. We will make 5 interest payments, the first one being January 1st, 2026, up to including January 1st, 2030, when we pay off the bonds. And we will pay bond interest based on 10%. Part 13.7 says, assume the same information above. However, we're going to use the effective interest method. As it says in instructions, set up the schedule of interest expense and discount amortization under the effective interest method. Hint, the effective interest rate must be computed. All right, so that's going to be a little different in that we have to compute the interest rate. So as always, let's get our facts. Okay, so the stated bond rate is 10% given to us in the problem. The maturity value, or so the bond maturity value, is $2 million. And we get cash proceeds today, $1,855,816. The issue date is January 1st, 2025, and the maturity date 5 years later is January 1st, 2030. And interest is paid January 1 of each year. All right, there's our facts. So let's estimate the effective interest rate, and then we'll provide for an amortization schedule. Right, as it says, the interest rate must be computed. There's a number of ways to compute this. You can use the tables, the present value and the annuity tables to get to an estimation of the interest rate. If you're familiar with your business calculator, you can use that. However, because we're working in Excel, I'm going to show you how to do it in Excel. All right, so let's first get a few items that we can reference. The first one here is the, let's note the term. And this is in years or period. And this is for 5 years, as given to us in the problem. So it's a 5-year term. What we also know is we know the amount of cash paid at maturity. And we know that's $2 million. Also given to us in the problem, and that's going to be paid at 1/1/2030. So that's given to us. Let's see, we also know that we have to make cash payments for interest. So interest payments. And so our loan is for $2 million. That's the stated value of the loan, as we noted above. So the maturity value is $2 million, and we have to make payments of 10%. So we make annual payments of 10% of the $2 million stated value of the maturity value of the bond. Okay, so this will be paid on 1/1/2026 on every January through 1/1/2030. So we have 5 payments: 2026, 27, 28, 29, and 2030. We have 5 payments of $200,000. So what we want to do is we know the present value of these cash flow streams is $1,855,816. However, what we don't know is what is the effective interest rate. We know what the stated interest rate is, that's 10%, but we do not know the effective rate. So we need to calculate the effective rate to be able to determine what is going to be the amount of interest expense that's going to be recorded for each period. We know the interest that's paid, but remember, interest paid does not always equal interest expense because of the market. And therefore, we need to figure out what is that market rate, what is that effective interest rate, given the facts of the problem that we have. All right, so we're going to try a few things here. So I'm going to use the present value formulas, and we're going to set up to try to estimate what do we think or try to get as close as we can to what is the actual effective interest rate. So I'm going to start with 8% interest. So let me change this formatting here so we can see this is going to be 8%. So I want to start with estimating, and it says that we're going to compute it. Since we're using Excel, we're going to have to use the trial and error method. So let's set up our formula. So the present value, the rate. Okay, so the rate, so PV is the formula in Excel. The rate is 8%. The number, how many periods are we talking about? What we're going to do first is we're going to back up the $2 million that we know is a cash flow 5 years from now. So we're going to back that up to the present value today. So I'm going to back it up for 5 periods. And the payment for that happens in 5 years is $2,000. So in this formula, the present value of 8% over 5 periods of a $2 million number, the present value for that is $7,985,420. And then we want to also back up the amount of the, give me a second here, it's not 5 payments, it's the future value. Let's take a look at that again. Look at that formula that popped up there at the bottom of my calculation. It says the PV, rate, number, payment, FV, and type. So the present value of the rate is 8%. The number is 5 years. I do not need payment, so I put an additional comma there. And the future value, so in the future, 5 years from now, it's $2 million cash flow. So the present value of that $2 million single payment made in 5 years today, assuming 8% interest, is $1,361,166. Okay, so that's the cash flow stream for the payment in 5 years. But we also have a cash flow stream for the interest. So I want to figure out the present value of my interest. So I'm also going to use the same 8%. The number, how many interest payments do we have to make? We have to make 5. 5 interest payments. And so here we are going to use the payment. What is the payment amount? The payment amount is $200,000. 1 comma brings me to future value. There is no future value to consider here because I'm just looking at the payment stream. And then the type. So this is the annuity. Is it an annuity due or is it an ordinary annuity? Because this is made at the end of the period, it is an annuity due. So therefore, I'm going to type a 0. So it selects that this cash flow payment is made at the end of each year. In our case, the end of each year would be the January 1st of the following year. So the present value at 8% of 5 payments due at the end of the year of each $200,000 payment, the present value is $798,542. So the total of that, let's sum those two numbers up and see if that equals or approximates our cash proceeds. It does not. We have cash proceeds of $1,855,000, yet 8% provides $2,159,000. So therefore, our interest rate is too small. We know at this point we need to use a bigger interest rate. So let's do a similar calculation, but I want to use 10%. So again, the present value at 10% over 5 years of a future value of $2 million is $1,241,000. The present value at 10% of 5 interest payments of $200,000 of an annuity due, so I'll type the 0, is $758,000. Do the same thing, add it up. Let's see if we're there yet. It's $2 million. Not a surprise, because that's the stated rate on our loan, on our bond, is 10%. So I'm not surprised that therefore we have confirmed that at 10%, we would have gotten $2 million. But that's not the cash proceeds we have. So let's continue. Let's try 12% and see what happens with 12%. So the present value of 12% over 5 years, the future value of $2 million would be $1,134,854. The present value of the interest payments at 12%, 5 payments of $200,000 due at the end of each period is $729.55. Let's see what that sums to. That is very, very close. So we have $1,855,809 compared to the actual cash proceeds of $1,855,816. So we're $7 off. I'm going to stop and go with 12% is the effective market rate of our bond. So therefore, we are paying less than the effective rate. And that therefore, when our market rate is greater than our stated rate, then we know we're in a discount period. So therefore, we know that 12% is our number. And now we can work through the next part. So it says, set up a schedule of interest expense and discount amortization under the effective interest method. Hint, the effective interest rate must be computed. So we computed effective interest to be 12%. That's what we did in the shaded areas in yellow. So now let's set up our schedule, because we want to create a schedule of interest. All right, so we'll say the schedule of discount amortization. And this is the effective interest rate method. And we found that to be 12%. All right, so the columns we will need the year or date. We'll need the cash paid. We'll need the interest expense. We'll need the discount amortized. And we'll need the net carrying value of the bonds. There is not the bonds. All right, so we've got our schedule ready. We're ready to set it up. Okay, on January 1st, 2025 is our first time period. And at that date, the net carrying value of the bonds is the amount of bond net of the premium or discount, which is basically the amount of cash we received. And the amount of cash we received was $1,855,816 given to us in the problem, and it's up above. And then 1 year goes by. So at the end of the year, let's change that. No, because I want to be able to capture the interest expense in the year. So the $200,000 cash paid, we know that's going to be paid the next day on January 1st, 2026. But I want to track that because I do want to see the impact to the amortization. So the interest expense is the amount of my carrying value of the bond throughout the entire year times the effective interest rate, which we estimated to be 12% above. So the carrying value of the bonds, the net carrying value of the bonds was $1,855,816 throughout the entire 2025 year. And so therefore, the effective rate we will multiply against that. We found 12% times the carrying value of the bond, and we get $222,698. Therefore, the discount that will be amortized essentially the very next day on January 1st, 2026, when we make our first payment. But the discount that will be amortized is $22,698. So slowly, the carrying value of these bonds, we know in 5 years that this is going to be, should be $2 million, because that's the amount that needs to be repaid in 5 years. So we're going to work this $1,855,816 up towards $2 million. And in the first year, we're going to amortize $22,698, which caused an increase of not only the carrying value of the bond, but notice that our interest expense is higher than our actual cash paid for interest, which makes sense in a situation where the effective rate exceeds the stated rate. Interest expense will exceed the cash paid. Interest expense is based on market effective rate. Cash paid is based on stated rate. And in our case, the market rate effective rate of 12% exceeds the stated rate of 10%. Next year goes by. We will make another $200,000 payment, and the interest expense for this year is calculated the same way, except our carrying value was a little higher, so our interest expense is going to be a little higher. 1,878,514 times 12% effective rate leaves us with $225,422 in interest expense. The amortization, just like we did in 2025, will be the difference between interest expense and the cash paid, which is $25,422. And as before, therefore, the net carrying value also changes of our bond. Now, $1,878,000 added to $25,422, we're at $1,853,000. I did not add that. I ended up subtracting it. Let's do the math correctly. There we go. There's the addition. $1,903,935, Next, 2027, same thing. $200,000 of interest. That's going to be the same thing 5 times. Let's just get that over with. So there's our 5 periods. We've got that in. Now let's calculate our interest for 2027. Carrying value times 12%, it's $228,472. Discount is the difference between the interest expense and the cash paid, $28,472. And as before, add the carrying value from the prior year plus the discount amortized in the current year. And again, for 2028, interest is 12% of the carrying value. Difference between the interest expense and the cash paid is our amortization for the period. Get us a little bit closer. Let's take that away. And then the last year, as before, carrying value times 12%. Interest expense less cash paid gives us amortization of our discount. And if we take the carrying value of the bonds plus the amortization for that year, we get $2,012,000. So right there, we're right at the amount. So we just had a little bit of rounding differences in there. If we wanted that to be exactly correct, subtract the 12 from here. Now we've got it. So what I did is I went back in and just adjusted the discount because it's got to be the number that makes it go to 2 million. So due to some rounding and our estimation being slightly off from the exact amount of cash we received, gave us with a $12 error. So I'll adjust that into the discount amortized. All right, so we double check. It says set up a schedule of interest expense and discount amortization under the effective interest method. We've done that, and we've based it on the effective interest rate method. So at this point, this does conclude the example to work a bond amortization when the effective interest rate is unknown and must be estimated.